Imagine waking up one morning and finding out that the world's largest asset manager quietly moved $70 billion into Bitcoin. Within weeks, banks around the world started sweating. Phones lit up behind closed doors, and emergency meetings were called. Liquidity desks went into panic mode while most people had no idea it was happening. This wasn't a crypto influencer tweet, and it wasn't retail hype. This was black. And what happened next triggered the biggest banking fear we've seen since 2008. The shift happened quietly, without headlines or public warnings. For years, Bitcoin was treated like a joke by traditional finance. Too volatile, too risky, too decentralized. Banks laughed at it on TV. Regulators warned against it, and big money pretended it didn't exist. But behind the scenes, something changed. Slowly and quietly, institutions began preparing. And when BlackRock made its move, it wasn't just buying Bitcoin. It was sending a message to the entire financial system. A message that shook the foundation of banking itself. Before we go further, if you want real stories about money, power, and what's really happening behind Wall Street headlines, hit like and subscribe right now. This is Market Truth Archives, and we break down the stories most channels are afraid to touch, because the truth usually moves in silence. BlackRock doesn't gamble. It manages more money than most countries. When a firm like that moves tens of billions into Bitcoin exposure, it's not speculation. It's strategy. And the moment banks realized what that strategy meant, fear set in. Because Bitcoin isn't just another asset. It's a direct challenge to how banks make money. It threatens how they control capital and how they stay relevant. Banks survive on trust and deposits. Your money sits with them. They lend it, leverage it, and earn interest on it. But Bitcoin changes the game completely. It allows value to move without permission. No middlemen, no bank approval, no overnight settlement delays. And when institutions start treating Bitcoin like digital gold, it creates a problem. Banks cannot easily solve. A problem rooted in control. As BlackRock's position grew, something else happened at the same time. Large investors started reacting, not all at once and not loudly, but steadily and deliberately. Money that once sat in savings accounts, bonds, and low-yield bank products began flowing into Bitcoin-related vehicles. That's when banks started noticing unusual outflows. Liquidity tightened and balance sheets got uncomfortable. Memories of 2008 came rushing back. In 2008, banks collapsed because they were over-leveraged and underprepared. This time, the fear is different, but just as dangerous. It's not about bad loans. It's about losing control. If Bitcoin becomes a serious reserve asset, banks lose their monopoly over money movement. They lose fee power and influence. And worst of all, they lose confidence. That's something no financial system survives without. Internal reports started circulating. Risk committees flagged crypto exposure not because Bitcoin was crashing, but because it wasn't. It kept surviving and recovering every cycle. Every cycle, it came back stronger. BlackRock stepping in validated what banks had tried to deny for over a decade. Bitcoin wasn't going away. It was growing up. Some banks tried to adapt. Others resisted. But panic doesn't come from what you can see. It comes from what you can't control. Regulators started paying closer attention. Central banks increased monitoring. And behind the scenes, emergency liquidity models were quietly updated, all to account for a future where deposits are no longer guaranteed to stay put. This is where the real fear lives. If even a small percentage of global capital moves into Bitcoin long term, it changes everything. Interest rates lose some power. Monetary policy weakens. Banks become just another option, not a necessity. That's a nightmare scenario for an industry built on being indispensable, an industry that depends on inertia and trust. BlackRock understood this before most people. Their move wasn't about short-term price. It was about positioning, about being on the right side of history. When the largest financial institution in the world signals confidence in an alternative system, others follow. Pension funds move. Sovereign wealth funds adjust. Insurance giants begin reacting slowly at first, then all at once. And when that dam breaks, banks won't collapse overnight. But the panic you're seeing now is the early warning. The quiet kind of panic, the kind that happens before headlines catch up. Just like 2008, didn't start with Lehman collapsing. This shift didn't start with a crash. It started with a reallocation, a silent movement of capital. A vote of confidence away from the old system and towards something new. What makes this moment different is transparency. Bitcoin runs on open rails. Anyone can see supply and verify transactions. Nothing is hidden. Compare that to the banking system. Risk is buried behind complex derivatives and closed books. In a world where trust is fragile, transparency becomes power, and power attracts capital. That's why this story matters. It's not about price charts. It's not about hype. It's about control, confidence, and the future of money itself. Whether you love Bitcoin or hate it, you can't ignore what's happening. BlackRock didn't trigger panic by accident. It triggered it by proving something banks hoped was false. If you've been watching this unfold and wondering what it means for regular people, you're not alone. This shift affects savings, investments, and financial freedom. And the conversation is just beginning. Drop a comment below and tell us what you think. Is Bitcoin the future? Or is the banking system stronger than we realize? Share this video with someone who still thinks nothing has changed. And stay tuned to Market Truth Archives. Because the biggest financial stories are never the ones shouted the loudest. They're the ones whispered first.